and thanks for watching this Trader's Edge video. This particular video is a deep dive on the stochastic oscillator and its variance. So before I begin, there is a survey to technical indicators or survey of technical indicators video which I would recommend watching probably before you watch any of the deep dives. It's an hour-long video, but it is worth the watch. I go over all of the most popular technical indicators. Your momentum indicators, your volume indicators, your market profile, moving averages, etc. That would be worth a watch. Like I said, this particular video is a deep dive on stochastic oscillators. Basically, the stochastic oscillator, it follows the momentum of price, or it shows you the momentum of price. So if that momentum is upward momentum, it indicates that. So in other words, your security is upward trending, or if there is downward momentum, it shows you that. In other words, your particular security is downward trending. So it's useful for that. I'm going to talk about the input. So in other words, what goes in to calculate the oscillator, the stochastic oscillator. I'm going to talk about the formula. I'm going to actually show you the formula that is used, and then we're going to talk about the different variations of that, and then how you use those oscillators to make, or those variations of the oscillator, in order to make trading decisions, entry decisions or exit decisions. Okay. So first, let's talk about, or actually, let's look at the oscillator. So this one here that I'm going to expand. This is the original stochastic oscillator. You can see it's a green plot line here. There are levels indicated. There's 80 for overbought and 20 for oversold. So in that respect, it's a lot like a Williams R or an RSI, where you have overbought, oversold levels. Okay. The inputs that go into it are the period or the range. So over how many candles on your chart are you calculating this? In this particular case, it's 14, and I think 14 is the most common. Some people use 10. I use 14. But you can see here on this day chart of the mini NASDAQ futures, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So from this candle to this candle is 14 trading days. So that is the range or period that we're talking about. The next input is the most recent close. So this candle closed right here where my cursor is. The next input is the highest price of that 14-day range or 14 period range on an intraday chart. The next input is the low of the period, so the low of the 14-day range or 14 period range. So in this case, this is the high of the 14 candles, and this is the low of the 14 candles. So those are those two inputs. Okay. There's also the type of average, because averages are calculated here. There's a simple average. If you watch the survey of technical indicators, you know that there is a simple, an exponential, a weighted, a Hull, and a Wilders. Now, I didn't go into a lot of detail in the survey, and I'm not going to go into a lot of detail here. I'm actually not going to go into any detail here. Watch out for the deep dive on moving averages, and I'll go into the differences between simple, exponential, weighted, Hull, and Wilders. For purposes of this video, it's just important to know that your platform may allow you to use, instead of a simple, maybe an exponential or a weighted, if that's your preference. Okay. There's also something called a smoothing factor, which I'll get into when I get into the variations of the stochastic oscillator for simplicity's sake. So for right now, we're just going to talk about the most basic of stochastic oscillators, which is this one right here. Now the formula is right here where I'm pointing my cursor. This plot line is called %K. I don't know why they called it that, they just did. Now, percent K is calculated by taking 100 and multiplying that by a ratio. And that ratio is the close. So in other words, the most recent close indicated here. And then subtracting the lowest low of that 14-day period, so here, and that gives you a result here. So the close minus the most recent close minus the lowest low of the 14-day period. Then you divide it by the price range. So what is the difference between the highest price of the 14-day period and the lowest price of the 14-day period? And that's what gives you your ratio. So again, real quick, most recent close subtracted by the lowest low of the 14-day period divided by the difference between the highest high of the 14-day period and the lowest low of the 14-day period multiplied by 100. That will give you a number between 0 and 100. Zero being here, 100 being here, 80 is the level at which we call it overbought, 20 is the level at which we call it oversold. Or sorry, yeah, oversold. Now, the idea behind all stochastic oscillators is that as price gets higher, in other words, the closer it approaches the highest high of your trailing period, the higher that ratio will be. Conversely, as the price approaches the low of the 14-day period, the lower that ratio will be. So I want to show you here, I have 3 different scenarios where we're using very simple, very round numbers. Okay, so let's assume that we're tracking a security and the high of the 14-day period is 20, the low of the 14-day period is 10, and it's the same high and low for all 3 of these scenarios, and we compare a closing price of 18, 15, and 12. So in that 10-point range, if the close is at 18, then we have a percent K of 80. That would be up here at the 80 threshold. Conversely, if we have the close is low is 12, so it's closer to the low than it is to the high, then our percent K is 20. So that would be somewhere down here. And of course, if the close is halfway between them, it's 15, or 50 rather, and that would be somewhere right around here. So these 3 scenarios here, and I should just focus on the top one for right now, these are actual numbers from this mini NASDAQ, this chart of the mini NASDAQ futures. Okay. So the close, which is this number, which is this area that, or level that I'm pointing to right here, this price level I'm pointing to right here, the NASDAQ futures closed today at 65.70.50. The high of the trailing 14-day period was 72.14.50, as you can see right here. The low was right here, where I'm pointing my cursor, and that was 64.21. If we take the low and subtract it from the close, and then we divide that by the difference between the high and the low, and we multiply it by 100, then we get 18.84. And you can see here on this chart, this bubble here shows 18.84. All right, that's how percent K is calculated. Now, the next variation of the stochastic oscillator is called the fast stochastic. And the fast stochastic, the slow stochastic, and the full stochastic introduce a second plot line. All right, now let me just edit this real quick. This 3, that's a smoothing factor. So basically what we did here was we introduced this red plot, which is percent D. Percent D is the 3-period moving average of percent K. All right, so what we did was we calculated percent K for the 14-day period from here to here. That's one input. From here to here, that's a second input. and then from here to here. That's a third input. So that was percent K at this close, and this close. All right, it's in the spreadsheet. So this was today, this was yesterday, this was the day before. Percent K today is 18.84. Percent K yesterday was 8.51. Percent K yesterday was 18.59. If you take those three and you average them, then you get 11.97. What do we have here? Percent D, 11.9798 rounded here. Okay. So why have percent D? Well, percent D is there as a crossover indicator. So if you watch the survey of technical indicators, one of the things I talked about when I talked about moving averages was that sometimes people use crossovers, not just when the price of the security itself crosses its moving average, but when different moving averages cross over each other. So if you have a fast moving average crossing a slow moving average, that can be a buy or sell signal. Let's talk about the golden cross or the death cross, which is a 50 period moving average, that's the fast moving average, crossing a 200 period moving average, which is the slow moving average. So if you're 50, you're fast, crosses above your 200, you're slow, that's called a golden cross. That's a signal to buy. That's a signal of upward momentum. On the other hand, if the 50 period, the fast, crosses below the 200 period, the slow, that is called a death cross, and that is a signal to sell or to short a stock or a security, because we now have downward momentum because the more sensitive indicator has crossed below the less sensitive indicator. It's no different with these stochastics. Okay, now the moving average is it's not a long range. I mean, it's 3. So we take the percent K over 3 periods, and that introduces the slower, less sensitive, the smoothed indicator, and when it crosses, so here percent K crossed above percent D, as you can see. So if you look at our security again, which is the NASDAQ futures, we've been in the downward trending for the last 14 days or so. Now this is potentially a signal that it's time to buy, because percent K, the fast, crossed above percent D, the slow. Next we move on from the fast stochastic to the slow stochastic. Now what the slow stochastic does, and I'm going to try to slow down here and just explain this as simply as possible because it might get a little bit confusing. What the slow stochastic does is it basically takes percent D, and that is now your percent K, or call it slow K. So in this case, the green line is fast K, which was just that formula over 14 periods. Now slow K is the same as slow D. So slow K is just percent K over 3 periods. So the moving average of percent K over 3 periods. Then slow D is now a moving average of this average. So I'm going to go into my input parameters so that you can see this. In this case, your D period is 14. Now, if I were to change that to 3, I think this is going to be right. It's going to slow down your percent D. Okay. Using 3 is not real typical in this case. You know, whereas this one is indicating an upward cross, this one is indicating a downward cross. All right. The default on your slow stochastic is 14. You can use 10 if you want. So it slows it down considerably. I'm going to use 14 in this case. So it makes it look even slower. Okay. Now, I talked about this when it comes to moving averages in the survey video. Fast versus slow, each one has advantages and disadvantages. The faster a plot or indicator is, the more sensitive it is to price changes. That can be good and bad because it means you can catch a trend change early. The disadvantage is it's more sensitive to price changes. So if price is very volatile, in other words, if it moves back and forth a lot, you can get whipsawed in and out of trades. You know, literally it can look like price is changing, you know, it's going from downward to upward, and then all of a sudden, whoops, you got whipsawed, now it looks like it's moving downward. So using some kind of a slowing factor or a smoothing factor helps to prevent a lot of those whipsaws in your trading. Let me see if I can find an example here where there was a downward trend So if we look at this period here, okay, fast K crosses below fast D, that's a short signal. And if you had done that, you would have been well served. Okay. Now, what happens is fast K crossed above fast D, and you would think, oh, now it's time to go long. And if you had done that, you would have been right for a while. But then potentially, once fast K crossed back below fast D again, you might have gotten whipsawed out of the trade, and you might have gone from long to short. Okay, so that's one of the disadvantages of the fast stochastic. If you were using your slow stochastic, you wouldn't have done that. You would have still gotten this downward signal here. In fact, you would have gotten the downward signal a little bit earlier. You would have gone short. It would have looked like maybe you're going to get stopped out, but then it continues downward. And even though fast or slow K starts moving upward, there's no crossover. So you wouldn't have been faked out here because the slope of slow D still indicates some residual downward momentum. Now, if you've watched my live stream, you know that I use the stochastic full, which we'll get into in a second. Stochastic full, really the way, you know, by default, stochastic full is the same as stochastic slow. The only difference is on stochastic full, I can change my slowing period. I'll get to that. I'll show you that in a second. But if you watch my live trader stream, then you'll know that I talk about, I like to use the crossover of fast K as an entry signal for a short in this case. And then some traders, once it crosses below oversold, will get out. I don't always do that. If I see that fast, or in this case, I'm sorry, slow D is still showing residual downward momentum, then I might stay into this. I might stay in this trade. Now I'll have a stop in place, but I might stay in this trade because I'm suspecting that because I'm still seeing this downward momentum, that I would be giving up quite a bit of profit. I think that even though this is a positive bar here, based on what my slow stochastic is telling me, I think that there's still some downside to this move, if that makes any sense. So that's the value of the stochastic slow indicator over the stochastic fast indicator, is that you do have a smoothing factor which helps you from getting in and out of, helps prevent you from getting in and out of trades too quickly. You can see, looking at the plot of the fast stochastic here, how many crossovers there are and how you would get a lot of false signals. If you went short every time fast K crossed above fast D, or sorry, if you went long every time fast K crossed above fast D, and then sold and went short every time fast K crossed below fast D, you would generate a lot of unnecessary trading commissions, which is a cost of doing business. Plus, you might also have some unprofitable trades because they would be false signals and they would turn against you, and they would presumably hit your stop if you're using stops. So I would say that the stochastic fast indicator is probably okay as using this crossover as an entry to get into the trade. But then you might want to use something else as an exit. You might want to just use, you might want to ignore these crossovers if you still see that your plots are moving downward towards oversold. You might not want to take a crossover as an exit signal and an entry signal into the opposite side of the trade. You might want to wait until your fast K crosses below oversold to close your position. And you can see, if you had done that here, you would have had a nice profit. You would have moved from about here down to about here or so. That would have been a nice move. That would have been a nice 600-point move between 72.14 and 66.37 versus getting whipsawed out of it here. You would have gotten out here at about 7.065. All right. Well, that's another 400-point move down to the downside that you would have missed if you had been using crossovers on this fast stochastic. All right. Which one you use is a matter of personal preference. Personally, I like to avoid seeing crossovers. I like to just minimize the noise. That's why I like having some kind of a smoothing factor or a slowing factor to slow the %D down just a little bit and to have fewer crossovers and just go off of, if both are above 80 and there's a crossover down, that signals a short. And then I might get out if slow K crosses below 20. But if I see that slow D is still moving downward, then I might consider staying in it so I don't give up too much of that move. There's still some move to the downside. If I believe this, that's going to happen. Now, I said I was going to talk about this full stochastic, and full stochastic is just a generalized version of the slow and the fast. But what you can do that's different is that you can change the moving average of your %K. So remember how I said that %K in a pure stochastic is just that formula? And then I said fast K is the same thing as %D, which is just the 3-period moving average of %K. In full stochastic, you could actually change your smoothing period of your %K to slow down %K if you want to. So let's just see, okay, so what happens if I change that to 14? I slow K way down, so now everything is 14. These two were identical before, but now I've changed the smoothing period from 3 to 14, which affected both K and D. So you can see that here, K is already below oversold. Here, K is already below, or is about halfway between overbought and oversold. And you can see that the D plot also changed. It's above 70 versus here it's right around 50. Okay, so it's going to change both. It's going to smooth that way down. Now, unless you have a high tolerance for pain, I probably wouldn't recommend changing your smoothing period on your full stochastic so drastically. And the reason why I say that is because you're going to have some up and down. I mean, take a look at this. Would you have been okay here? Like seeing this reversal from here on the 23rd to this big move up on the 26th, giving back a lot of your profits, assuming that you got in, you got short here. If you can say yes, then maybe you would have been all right, because slowing down these stochastics is telling us that there is still significant move to the downside if we believe this chart. All right. I don't use it that way. I just leave it at the 3 at the default. So really, if I wanted to, I could just use the slow stochastic, but I use the full stochastic because I also use the full stochastic histogram now. So the full stochastic histogram is really nothing more than a histogram that plots the difference between your K plot and your D plot. So you can see that when K has crossed below D, the further below D it goes, the bigger this negative histogram plot gets. And you can also see that when K crosses above D, the further away it gets from D, the bigger the histogram to the upside gets. Okay, so the histogram is, for me, a handy visual way of seeing opportunities to go short and opportunities to go long. All right. Now, the way that we could have smoothed this out, because you see kind of this fake out here, this tells you that you should have, this would have told you, if you believe it, go to the upside, and you would have been right. It would have moved up until you got to about here, and then it peaks and starts to go downward, but then you see this cross below. Well, how could we have kind of eliminated that if we wanted to? If we want to minimize how many transactions we do, we want to minimize our commissions. Well, remember that I was able to change that smoothing period from 3 to 14. Let's not change it from 3 to 14. Let's change it from 3 to 9. Let's just do that. So we change this to 9. We're going to have to change it here too. So our slowing period we change from 3 to 9. Now we basically eliminated potentially a false signal. Because remember here before where it crossed, there was a cross below and then a cross above and then a cross below again. Now that might not have been okay, because this looks like downward momentum, but here we're seeing upward momentum. So depending on the type of trader that you are, you might have preferred to have that signal be there. And I wouldn't necessarily call it a false signal, because if you would, if you had gotten long based on that crossover, you would have been okay, because you see there's a pretty big move upward here until it peaks. Let me change these back so you can see what I'm talking about.
Dinner.
So there was a quick crossover down, which was a false signal, but then there was a crossover up, which actually was a valid signal, because it did show a pretty decent move to the upside. Then we got another reversal and a cross down, and that was a significant move to the downside. Okay, I'm not telling you how to set your parameters. I'm just telling you, I'm just want to show you what the impact is if you do change those parameters. I would encourage you to experiment, figure out which one works best for you. Maybe try all of them in a paper trading situation. Try each of these different variations, see which one works best for you. Play around with the parameters that go in there, the different smoothing factors and what have you, to see what you're comfortable with. Another thing that I find helpful, and you'll know this if you watch my live trading stream, is that I like to take a look at stochastics across multiple time frames. So, looking at this here, this is a tick chart, a 1 minute, a 4 minute, and a 15-minute chart. This configuration is for my day trades. You might want to use longer time frames if you're a swing trader, or if you're a longer term trader. If you're not day trading, if your hold period is not intraday, if it's multiple days or multiple weeks, and you would go with longer time frames. But I like to look at stochastics across multiple time frames for confirmation. So here I'm seeing, if I'm looking at just the 4-minute chart, I think I'm about to see a crossover to the upside, right? But if I look at the 1-minute chart here, I see, yeah, there was a crossover to the upside, so I think that there's going to be some follow through here. Now, conversely, looking at the 15-minute chart, this would tell me that there's still some downside, right? Now, it's important to understand the context that you're operating in. You need to see the big picture. I need to know that in my 15-minute chart there's downward momentum. Okay, I need to know that in my 1-minute chart that there is temporarily upward momentum. So I might be able to do a quick, if I'm fast enough, I might be able to do a quick, get in a quick long here and kind of scalp this and wait till this upward, upside move is done and then get out. Okay, I don't generally like to do counter trend moves. So if this stochastic here is telling me that there's still downward momentum, I might want to wait this out and wait till this gets up here and then have it show a sell signal and then get into a sell trade that way. All right, just some food for thought. The point really here is that it's very helpful to look at these across multiple time frames to get some context. Don't drive yourself crazy. Don't go from using the 1-minute chart for your entry signals to using now I'm going to use the 4-minute chart for my entry signals, and oh wait, maybe I should use the 15-minute chart for my entry signals. You're going to drive yourself crazy that way. You're going to get whipsawed in trades. You're going to lose money, and you're going to pay a lot of commission costs. Look at your indicators, your stochastics in this case, across multiple time frames. Do it in a paper trading environment. What would you have been comfortable with? If you were using this 1-minute chart, would you have been comfortable watching this turn against you? Maybe not. So then if that's the case, maybe then you use a 4-minute chart instead. But you won't know that until you're actually looking at it when you see those losses, if they're losses racking up, or you see your green, your profits temporarily disappear. Because just because this looks like this in this chart doesn't mean that in the equivalent time frame, so here you wouldn't be given back that same profit, because you would have been. It looks different on these charts. So that's the summary of stochastics, the inputs that go in there, the formula by which it's calculated, the smoothing factors, the different types, and then how signals are generated. So we talked about how potential signals can be generated. It can be a crossover of your fast below the overbought threshold or above the oversold threshold. It can be a cross of fast K over fast D, so a cross downward, potentially using a cross below as your exit signal. So in this case, if I went short here at this crossover, I stay in it until until K crosses below oversold, and then I would get out. Or sometimes, like I said, I might use the crossover of D below that threshold. Now I know that the downside move has completed or is pretty close to completing, and I can get out. Remember that the difference between fast and slow, you want a combination of indicators that are sensitive to price changes so you don't miss the move, you don't get in after most of the move has already happened. But you also want to, you don't want to get whipsawed. So that's the purpose of a slow indicator. So, the best thing to do, like I said, is just experiment with these in a paper trading environment, experiment with the parameters, changing the inputs, and see what works best for you. At the end of the day, the best trading system is the one that you create for yourself. And by experimenting with these things, you can create your own trading system. I said this in the Survey of Technical Indicators video. There's a lot of trading systems out there for sale. I think most of them are a waste of money, not because they're bad trading systems. I mean, there are bad trading systems out there, but that's not why I'm saying that. Why I'm saying that is because it's not your trading system. It wasn't optimized for you. It wasn't created by you. When it's created by you, it's based on how you trade and how you respond and how you think emotionally and psychologically. Also, because you created it, you're vested in it, so you're more likely to trust it, especially if it's trustworthy. If it works for you and it's trustworthy, you basically got it for free other than just investing of your time. So that's the conclusion of this video. Again, if you haven't watched the Survey of Technical Indicators, watch that one. Look out for more deep dives on other indicators that were covered in that video. And thanks for tuning in.